Welcome and thank you for joining this Each One Teach One Financial Literacy series video where we will discuss understanding mortgage basics. My name is Nikki Vanden Heuvel and I'm a Learning and Development Coordinator with Fusion Credit Union, as well as a certified Each One Teach One financial literacy coach. Fusion has partnered with Each One Teach One as a way to provide our members with financial education options so that they can confidently manage their finances. Because of the high cost of most real estate, very few people can purchase a home with savings alone. Therefore, if you are like the vast majority of people, you will be borrowing money from a financial institution to purchase the property you want. Called mortgages, these loan products can be quite complicated. Knowing the basics of how mortgages work can help guide you to the loan that is most appropriate for you. Although there are many different types of mortgages, there are 4 basic elements that you need to understand in order to understand how mortgages work. Amortization is the period of time required to completely pay off a mortgage debt, if all payments are made on time and the terms of the mortgage stay the same. Typically, amortizations for mortgages are 25 years. What's important to understand is that the amortization period of a mortgage affects how costly that mortgage is. Consider the following. Usually, the longer the amortization, the smaller the monthly payment. If your amortization period is long, you can expect to pay less month to month. However, the longer the amortization period is, the higher the interest cost. So you can choose between making larger payments and reducing your overall interest cost, or making smaller payments but paying more in the long term. What you choose to do will depend primarily on your financial circumstances. Although, again, it's important to understand that paying off your mortgage quickly will reduce the overall cost of your mortgage. An interest rate is the amount that a lender charges you to borrow money. It's expressed and charged as a percentage of the amount borrowed. The interest rate on your mortgage determines how expensive your mortgage will be. A high interest rate will result in more interest costs over time. It's better to secure a lower interest rate and pay off your mortgage as quickly as possible, though doing so may require higher monthly or weekly payments. Let's take a look at the interest rate types available. A fixed rate will not change for the term of the mortgage. If your interest is 5%, it will remain at 5%. This stability makes the most secure type of mortgage for buyers. With a variable rate, the interest rate you pay will fluctuate with the rate of the market. Usually this will not modify the overall amount of your mortgage payment, but rather change the portion of your monthly payment that goes toward interest costs. If rates go down, you'll end up paying your mortgage back faster. If they go up, more of the payment will go toward the interest and less toward repaying your mortgage. This option means you have to be prepared to accept some risk and uncertainty. Time for a question. True or false? You can save thousands of dollars in interest cost by making accelerated payments on your mortgage. The answer here is true. As we'll see, the benefit of an accelerated payment plan is that you will make the equivalent of one extra mortgage payment each year, which pays off your mortgage more quickly and saves you significant interest payments over the length of your mortgage. Here are the standard payment schedule options. Monthly. You pay once a month for 12 months, which means 12 standard payments per year. Semi-monthly. You make 24 payments per year. The total paid at the end of the year is the same as the monthly option. Biweekly, or every 2 weeks. When you make biweekly payments, the total paid at the end of the year is also the same. Accelerated biweekly. You make 26 payments per year, but you'll make the equivalent of one extra payment per year. Weekly. This is 52 payments per year. And accelerated weekly, you'll still make 52 payments a year, but you'll make the equivalent to one extra payment per year. This can help save you money in interest costs and help you pay off your mortgage faster. Let's take a closer look. This slide further demonstrates the amount of money you can save using an accelerated payment schedule. Specifically, this slide compares a monthly payment plan and an accelerated biweekly plan. The borrower on the monthly schedule is making a total annual payment in the amount of $33,619.92 per year. At 7% over 25 years, the total interest cost for this borrower will be $440,498.90. The borrower on the biweekly accelerated schedule is making total payments in the amount of $36,421.58 per year, or approximately $2,800 more per year than the borrower on the monthly schedule. At 7% over 25 years, the total interest cost for this borrower will be $348,073.71. This is a savings of about $93,000 over 25 years. If you're able to afford an accelerated payment plan, that is, if it's reasonable for you to make an additional month's worth of payments every year, then you should consider it. Over 25 years, you can save a lot of money. As always, before deciding which payment plan makes the most sense for you, make an appointment to speak with a representative at your financial institution. As you shop for a mortgage, it's important to understand that there are many options available. In particular, you should understand the different term options available. A term is the length of time that the conditions of a mortgage, such as the interest rate you pay, are carried out. Terms are usually between 1 and 5 years. At the end of the term, you can either pay off the mortgage or renew it, usually with new terms and conditions. An open term mortgage lets you make payments ahead of schedule without paying a penalty. So it's a good choice if you think you'll be able to pay your mortgage off early. However, the drawbacks are that an open term mortgage is typically a variable rate and the interest rates are typically higher. A fixed or closed term mortgage typically offers a lower interest rate than an open term mortgage. However, it doesn't offer the same flexibility. In an open term mortgage, you can make additional payments and even pay off your mortgage at any time. In a fixed term, you can't make payments outside the payment schedule without incurring additional expenses or prepayment penalties. Although there are some exceptions, when you agree to a fixed term mortgage, you are agreeing to hold the loan for the entire term. So with a fixed term mortgage, you will enjoy a lower interest rate compared to the open mortgage, a predictable payment schedule, but you must pay a penalty if you make extra payments above a certain amount or prepay the mortgage in full before the maturity date. If you prefer to make regular payments over the long term, you'll probably save more money in a fixed term mortgage because you'll pay a lower interest rate. Again, it is important to note that one of the main differences between an open and closed mortgage is the interest rate. Open mortgages usually have higher rates and little to no prepayment penalty. However, fixed mortgages have lower rates with prepayment stipulations and possible fees. A high ratio mortgage is a mortgage lent to a borrower who has less than 20% down. It requires mortgage default insurance. If you plan to buy a home with a down payment of less than 20%, you'll need to purchase mortgage default insurance. This type of insurance protects the lending institution from the costs they bear if a homeowner defaults on their mortgage. Mortgage default insurance is a requirement enforced by the Government of Canada and is in effect at all lending institutions nationwide. The Government of Canada currently requires a mandatory mortgage rate stress test on mortgages. This stress test essentially determines whether a borrower can continue to pay down their mortgage even when interest rates change. For more information on stress testing your mortgage, contact a representative of your financial institution. Your home mortgage may be the largest loan you ever take out in your life. No doubt it will be expensive. However, with the newfound understanding of how mortgages work, you should be able to minimize the cost of your mortgage and save thousands of dollars. To recap, to save money on your mortgage, consider undertaking the following strategies. Increase your payment frequency. Shorten your amortization period. Increase your regular payments. Choose a mortgage with a prepayment option. Invest your tax refunds and cash windfalls. If you're lucky enough to get a cash windfall or a tax refund, put it toward a lump sum mortgage payment if you're able. If you would like more information or have further questions, please contact your financial institution for assistance.